Thank you for joining the call on a Monday afternoon in the summer. That's always hard to do, so I appreciate everyone taking the time to come and listen. My name is Ryan Payne. I'm the president of Payne Capital Management. We're a registered investment advisor out of New York City and Philadelphia. And the topic of today's webinar is how to add a recurring revenue stream and increase the intrinsic value of your practice. And just by way of background, it's a family-owned firm, Payne Capital Management. My father, Bob Payne, and I own the practice. We are Merrill Lynch alumni, and coupled together, we have over 55 years of experience in the investment management business. And, you know, we started Payne Capital Management about 8 years ago. We manage just shy of $600 million in assets right now, but I think the big point that I'd like to get across is we're growing organically at about 30% a year, adding roughly $100 million in AUM or money under management on an annual basis. And why that's important is we've built a model that is towards growth. And with the select group of insurance agents we've worked with for the last couple of years, we've developed a model to help you open and maintain more business, specifically in the light of the new DOL rule, which I know we're all trying to scramble and figure out what adjustments we have to make to our practice. And this is going to be the main theme of what we'll talk about today. So having said that, the world has definitely changed. And two things I want you to think about as I walk through the presentation and the slides, and I promise you I will not take too much of your time today, we'll stick to the highlights, is when you think about your own practice, how many households are you currently managing? If you had to do a monthly service call to all your clients this month, would it be possible? Could you do it? And what if you were able to delegate to a team that did all the service for you and you were able to take credit for it? So think about those two things as I walk you through this, and I love that picture there. That's how I feel on a Monday. Couldn't resist putting that in here today. So let's talk about right now. The world has changed, right? The DOL fiduciary rule is upon us. We're in a new territory with regards to where the business is going, and bottom line is the DOL fiduciary rule basically says giving advice in the best interest of your clients, earning reasonable compensation, and providing appropriate disclosure and transparency about the products and compensation involved. Now, I realize this is germane to 401ks, IRAs. However, I have to think, even though it doesn't apply to brokerage accounts, somehow, some way, this is going to trickle over, and it's all essentially going to have to be somewhat compliant. So having said that, what I see in terms of challenges for all of you, and you probably have figured this out on your own already, is that there's going to be a lot more work, a lot more paperwork. You can still receive commissions on the sale of an investment insurance and insurance inside an IRA if you demonstrate that the investment or insurance product is in the client's best interest, but be prepared to sign a lot of paperwork. In fact, just give you an idea of some of the things that you now have to do. You have to affirm fiduciary status in your advisory agreement in writing, estimate in writing all fees and expenses for the upcoming year, and an accounting of all the prior year's fees, expenses your clients paid, and the broker, advisor, or firm received. Provide a list of conflicts and a written description of how conflicts are managed. Affirm there will be no proprietary products or principal trading. So there's a lot more things you're required to do, and I have to guess with growing your practice and the amount of work you put into your practice on a daily basis, there's probably not a lot more time to do these things. So, what we see is the reality of it is it's going to be the survival of the fittest, right? It's our speculation that a lot of advisors and agents are going to be gone. They're just not going to make it. And the ones that do make it aren't only just going to make it, they're going to really thrive. And we think there's really two keys to surviving and thriving as opposed to falling by the wayside. And first is you're going to have to explore new business models and segmentation strategies for your clients. You're going to really have to move forward and rely better on technology and provide a higher quality advice to your clients to thrive. And you're seeing this already. I think it's been happening for a long time, but retail clients specifically are needy if you haven't noticed. I don't have to tell you. We all have scars from dealing with difficult clients over the years, but in my experience, and you can probably attest to this as well, clients are becoming more demanding, and the quality of advice that they want is going up. And doing it in an advisory capacity seems to be the way of the future, and the DOL rule really just solidifies that. And you can look at it overseas. I believe it was in Britain recently where they just banned commissions completely. So we know where the world is going. So the question is, how do you not just survive but thrive in this new era as a financial services expert? And at Payne Capital Management, what we've developed is a turnkey solution. And it goes back to, and a lot of you probably already run your practice this way, and you're probably doing it the right way. But what we found is running your practice as a goal-based investing type of relationship with your client is critical. Really bring in the retirement planning, tying every single investment into your actual client's goals, right? This isn't any new territory we're talking about. Whatever you recommend on the insurance side, managed money side, some way, somehow, you really want to correlate it back to their goals. I found that the most successful agents, advisors in the industry, that's exactly how they run their practice. Now, to take it a step further, I think the one issue is a lot of times you have clients that may have insurance products over here, and then over here they may have managed money. But the reality of it is, what we don't see a lot of times, I think this is going to be more important than ever, is that managed money that you may have over here is being recommended in concert with whatever insurance products that you're recommending over here. And what I mean by that is, instead of in recommending these things separately or not having them tie in, is going to be a real danger, and you're missing out on a lot of opportunities. And I'll just show you what I mean, how we put these proposals together for our clients and our insurance agent partners, and how we tie everything together, and what a powerful message that brings, and really helps to expand your business and get in front of more people and open more relationships when you get in front of them. I put up here just a portion of what we call our wealth projection. And this wealth projection basically maps out what a client's goals and financial life is going to look like over the next 20, 30 years. And in this case, I'm using John Smith, who's fictitious, but it's a real case. Just change the names to protect the innocent. You can see here what we did is we listed on this page in the middle, if you're looking at it, is the current accounts that this client has. So they have some accounts at Janney Financial, that's Janney Montgomery Scott. They have some cash accounts with about $925,000 in what we would call managed money. Now, you'll notice under the first account, it says less annuity. So in this case, the insurance agent decided, okay, I want this money carved out to create an income stream, and I want this money over here as managed money for the long term. And we build that right into the proposal so that when you meet with this prospective client, again, they're getting a full recommendation, not just a collection of products recommended to them, and also gives you protection in regards to being a fiduciary under the new DOL standard. So then, if we go to the next page here, what I did is, and this is how we do our reviews, is we break down all the income that's going to be created for the client in retirement. So most likely they're going to have Social Security. We hope they keep up with inflation, but those numbers have been a little weak in terms of how they grow with inflation. And in this case, we put in the agent's income streams that he's projecting he's going to create for the client long term. So in this case, the client knows, here's my current income streams that are going to come in. We also put in all the different expenses we expect for that client to have in retirement, everything from Medicare cost increases, unanticipated healthcare needs, travel. A lot of clients like to add travel expenses, home maintenance, a new car purchase in this case. And the one issue is, for all your clients, when you're creating safe money or you're creating a current income stream is, well, they don't go up over time, less Social Security, and it's arguably how much that goes up. So if the client's getting $14,000 from an annuity income stream, well, the problem is inflation is going up, and that $14,000, and I don't need to tell you, this isn't going to buy you what it buys you today 20 years from now. So this is where we bring in the managed money component. We need that money to grow over time as a supplement for the income that's going to be lost from rising cost of living. So by putting it all together into this wealth projection, if I go to the next page, you can see here we actually factor in what the client's taking from their portfolio. If you go to the bottom of that screen to the wealth table, you look at the withdrawals. These are the withdrawals the client is going to need above and beyond what income streams you're generating from annuities and any sort of Social Security benefit that's coming in. And the problem is because cost of living goes up, you can see that withdrawal column increases. The first year in 2016, they need 63 grand. Go down to 2031, they need 94 grand from their portfolio. And in this case, we looked at what kind of rate of return do they need on their money to keep abreast of inflation. In this case, the client needs under 6%. So they don't need a huge return, but they do need a return as a supplement over what other income streams are being created in their safe money, or specifically a lot of the annuities that you're creating. So by creating a document like this, again, it gives them a holistic approach to what they're trying to do, and it ties in what you're doing, again, with your annuity income streams, insurance products, along with marrying it to a managed money solution so the client gets, again, one solution. The other thing I'll show you here, and again, I look outside of my office right now, I have a whole team of people that just work on our proposal desk. And just to give you an idea of the volume, we have about 50 proposals a month that we're doing. So if you get a client statement, you get information about their retirement, we can put all these numbers together for you, and you can basically, have the proposal done, have everything analyzed, so when you sit in that meeting, you're prepared to open the accounts and give the client the best advice from the context of a goal-based retirement plan. So one other thing I'd like to show you here is we also put together a spreadsheet. It's a very simple looking spreadsheet here. It's not the sexiest looking document in the world. However, and again, in the world of DOL, if you're going to move money out of an IRA or 401k, you have to be able to prove that it's a suitable recommendation for the client to move the money. Well, we built this spreadsheet to break down everything they have in those managed accounts at competing firms. So in this case, again, we're using Janney Financial. It could be Merrill Lynch. I'll pick on Merrill Lynch. I'm an alumni of Merrill Lynch. And what we do is we break down all the assets they have. So you can see here, if you look up top here, we break down what's in equities or in the market at risk, what's in fixed income, which would be bonds, and in this case, what's in cash. They've got a lot of money in cash here. We see that a lot. And then we break down, if you see these columns at the bottom here, everything from where it's invested in. So for the money that's invested in the market in this case, we break it down by category so we can see how diversified that specific client is. How much do they have at small cap growth, small cap value, large growth? If I turn to the next page here, if you go under alternative investments, they have 54% of their money in alternative investments. In this case, it happens to be real estate. That's not diversification, right? So we're able to show the client why they should move, why it's suitable to move, and why they might need to be more diversified. And I can tell you, out of the 50 portfolios a month that we review, most people are not diversified. They think they are, but they're not. They have a lot of investments in a lot of different places, but they tend to be invested in the same area, and this spreadsheet basically breaks that out for them, breaks it out for them and shows them where they have holes in their portfolio. Now, if you go to the bottom of this slide, this is the real coup de grace in my mind. Again, when you have someone who's getting ready for retirement, they're in retirement, having a steady stream of income is critical. And one of the most important things when it comes to a managed money account is how much income is being created on an annual basis, right? Income payments are much more reliable than market appreciation. And the last 2 years are a great example of markets not really going anywhere. So this specific client is getting about 2.69% just in income on their portfolio, or 34 grand a year. Furthermore, they don't see this, but we go through and we break down all the fees the client is paying in their managed money accounts. So in this case, it's 1.63%, and these are all internal costs. And we go through every single account, we break down the internal cost so the client really knows what they're paying on an annual basis. And then what we did is we put our proposed right below that, where we can increase their income by 3.42% a year, or 43 grand a year, and reduce their expenses down to 1.31% a year. Again, just reallocating the portfolio, getting better diversified, using lower cost indexes for a lot of our portfolio, and we also use a portfolio bonds which the client owns outright. So again, creating more safe money in the portfolio. The bonds we own aren't bond funds. They're real bonds that pay interest income due. And in this case, between increasing their income and reducing their expenses, if you go to the right-hand side there, that's another $13,000 in this client's pocket a year. Wow, right? If you think about that, just reducing the costs, and increasing the income on day one when they move the portfolio, over 12 months, they're going to be $13,000 richer, irrespective if the market goes up or down. And just to really drive that point home, we compound that out for the client as well. So if you can increase your income and reduce your fees by 13 grand a year, if I was to compound that out over 20 years, in this specific case, it would bring $295,000 into the pocket of this specific client. So it's very powerful to look at the income the portfolio pays, look at the risk that's in the portfolio from diversification, and cash flow. Cash flow and fees. How much is the portfolio costing the client, especially those hidden fees, and how much cash flow can you create to make it more like a pension-like income in retirement, as opposed to a wealth accumulation engine, and people getting near retirement, in retirement, can't rely on a growth accumulation type strategy. Okay, so having said that, let's just say we got a great plan. The client decides, yes, this is what I want to do. I want to work with a concerted team where all my assets are working in a concerted effort, rather. It's all good if there's someone to implement the strategy and maintain the strategy, right? I mean, it's not something you can just plug in and hope for the best in 20 years. So one of the really unique or magical things about our firm, I'll use that instead, is our service model. And as far as I know, we're the only firm in the country that actually has this service model. And that is, for every client that comes into the firm, they're assigned a wealth advisor that contacts them, depending on the size of the relationship, on a quarterly or monthly basis. Okay? So they're getting a very high level of service that's proactive. And what happens by having someone dedicated to your clients is it's almost like you have an extension of your team basically out there managing the relationship for you. And what we found is, and this is one of the reasons why our growth has been so tremendous, is you can't help but what I call get in the way of money. And what I mean by that is, if you're talking to your clients on a regular basis, you find out, Mr. Smith has an IRA or a 401k that he can roll into an IRA. He's leaving his job. Mrs. Smith just sold her house. And my wealth advisors are trained not only to find this information out, but to let you know first so you can decide where the money goes. How much should go towards insurance products? How much should go towards managed money? But by talking to the client on a regular basis and updating their goals every 12 months, I make it a rule, the client's constantly being serviced. We're abreast of anything going on, and what we found is our attrition rates are almost zero. They're very, very low, because clients don't leave you when they get serviced all the time, and they don't keep you a secret. So money that's in motion from any sales of real estate, rollovers, if they're talking to a friend, they'll mention their advisor was just speaking to them, referrals, all those things come your way by implementing a service model that has proactive monthly or quarterly service. It's a huge point, and it's a game changer in terms of you building the managed money portion of your books. Our ongoing service model is designed to keep your clients on track for their goals, utilizing a transparent, low-cost investment strategy that basically just ensures ongoing suitability, which again falls right in line with being compliant with the new DOL rules. So having said that, again, building a strategy that's more of a turnkey strategy where you can delegate these things out so you can focus on your core business. And the one thing I really admire about insurance agents specifically, in my opinion, are the best marketers in America, period. Most of you are out there really, as they say, out in the trenches hunting. I mean, you're doing seminars, you're out there marketing for real, and I've never seen anyone do it better than insurance agents. And you work your tail off doing it. And I really admire it because I come from Merrill Lynch, and at Merrill Lynch, the brokers were pretty lazy. Our strategy for getting new clients was what we called sit and swivel. What that means is we'd sit in our chair and swivel around and wait for a broker to leave the firm so we could take their clients. So, coming from that environment, I really appreciate how good a marketer most of you are. But the toughest part about your business, in my opinion, is you work so hard all year, you bring in new money, you put together the seminars, and it's a real hustle. And when January 1st comes around every year, you start again at zero. Ouch. You have really nothing to show for it. You've got to do the same hustle again. And you have no real intrinsic value in your firm, because if you leave, the production stops. Furthermore, and even if you're doing managed money and you're doing it on your own, you leave, the production stops. You're not managing the money anymore. The money goes elsewhere. And with how hard you work, and given where the rules are now, it makes sense to me that you want to have a strategy that has some recurring revenue, that builds real value in your practice, And when you walk in on day one, those fees are coming in. And the key is not getting necessarily getting the highest payout on those fees. The key is the compounding, is keeping that money there for a long time. So implementing the right service model to keep these clients invested over the long term and have those headaches delegated out to another team that's proactively calling your clients takes the headaches away from you, but also ensures the stickiness of that money. And I just want to plant a seed with you, and I'll end with this, is just to think about where your practice can be and where it could be over the next couple of years. First off, I'll just give you an example. One of the better insurance agents we work with, one of the best in the country in my opinion, in Northern Florida, she raises about $20 million a year with us, never mind the insurance business that she does. We've been working with her for 5 years, and I just looked, we sent her a check last quarter for $131,000, and that's going to go up this quarter because the market's up. So that's, $500,000 a year coming in no matter what happens. If she decides I don't want to market anymore, I want to cut down my staff, I want to help manage the relationships that I have, but I want to take time off. She's got $500,000 coming in the year, starting day one, no matter what production she does on the insurance side. And I just did a model here just to get in your mind the idea of that compounding and how it's kind of a marathon, not a sprint. But if you could just add $10 million a year to manage money and keep it there, right? Have a strategy in place where the money stays there, the clients are serviced. Over 5 years, just going back retrospectively, that'd be $216,000 in revenue that would be coming in every year. Again, with you completely delegating that out so you can focus on what you do best, and that's growing your practice. You go out 10 years, that's $500,000 a year coming into your practice. Now, I mentioned this woman in Florida. She did it in 5 because she's doing double the amount that I'm showing you here. And for a lot of you, hey, $10 million might be easily done and raised every year. For some of you, that might be a stretch, but you can see how these numbers over time have a huge impact positively on your practice, and again, create real intrinsic value. So, to wrap up here, thank you again for taking the time to listen in, especially on a Monday, a very nice Monday. I wish I was outside here in New York City. But, if you're interested in seeing how you can possibly work with us, again, come out with work with a turnkey solution where basically you're able to delegate the managed money out, create a concerted effort that's more in line with the DOL rules and really, really jumpstart your business this year. Give us a call just at 646-641-7670. Schedule an appointment to speak with myself or my father, Bob Payne. You can check us out on the web at www.paynecm.com. We've got a great site. We've got a lot of content up there, fresh content. And if you'd like to book a time to discuss further, let me know a little bit about your business, about your book, what you're trying to do with your business, and see if there's any way we can help you. Email our associate, Emily DiValente at emily.divalente@paynecm.com. She'll get a time. We can hook up there and talk and get a real feel for what you're doing with your business and how we can really, really ramp it up here and be proactive in light of all the changes happening. So I'll leave with that. Again, thank you very much for attending the webinar today, and I hope to speak with you soon. Have a great day and be bullish.